Morning, everybody. It's 11 o'clock. We'll get going. Just a reminder too, because I think most people will be watching on YouTube now. But so if you are, by all means, put questions into the chat there, and then one of the team here will be copying them into the Q&A for me, so I can see what's going on. Please don't forget to do that. So welcome. We've got a busy week. I've got some news to run through. We've got Andrew talking about what happened over March, and then Richard's going to be talking to our guest this week, who's Simon Farnsworth of Life Sciences REIT. So bits of news. This is going back because obviously we didn't have a show last week, so it was Good Friday. So just looking at what's happened since the 25th of March. Just a few little things to pick out. JP Morgan American first. Results. So nothing particularly exciting in the results, but except that the numbers are just great. And you can see this chart here. This is a 10-year chart, and it's almost going up in a straight line. It's just crazy, really. And it's got so good now that it's trading at premium and issuing stock. And that's obviously very good news. We need as many good news stories as we can in the sector at the moment. And it's already a £1.8 billion trust. I think it could get an awful lot bigger. The results were great. And to beat the S&P 500 last year was a really quite impressive move. Very few people managed to do it, whether they were US money managers or based here, didn't seem to make a difference. Obviously, that skewed the returns of the world index. Everywhere you go, active managers were tending to underperform. So to beat the index and to beat it by that kind of margin is really quite good. And more importantly, since they changed the approach to running the money, it's built up now quite a good track record of beating its benchmark, which I think is also a big tick in the box. Here are the numbers from their fact sheet to the end of February 2024, and you can see that just over every time period now it's ahead of the index there, which is obviously good. And the approach, I like it. It's actually, it didn't occur to me this morning, but it's similar in some ways to what Alliance Trust is doing. So rather than betting on value or betting on growth, it's got a mixture of the two. And it tries to run it so that within sort of like 40 to 60%, you've got roughly half and half of the fund in value or growth. And you can see how that's gone over time. That graph looks a lot more dynamic than it should be because obviously the indices are cut off here. This is just showing the 40 to 60 range. So although that looks like a big move, it's not massive. But obviously a little bit more in growth at the moment than in value. And that's what it looks like in the portfolio. So you've got a lot of kind of IT type stuff, but actually an underweight relative to the index, and overweight financials, and many of which are value stocks, which is interesting given what happened last year. Remember, we had a lot of banking crisis in the US, but I think that probably made a lot of US banks cheap, a lot of financial stocks cheap. And that's definitely what the managers of Pelican Financials would tell you too. There's a holding in Tesla in there, but that has gone by the end of January. So I don't think they got caught by the latest bad figures, which is obviously good news. And then it's a good sort of spread of stuff, but a reasonably concentrated portfolio. So 40 stocks in the large cap portfolio. Obviously, big chunk of whether you outperformed last year was whether you held these Magnificent Seven stocks. And you can see the numbers there, and these have been magnificent for a while. I mean, this is not a new phenomena, but last year was particularly acute, and they generated a big chunk of the returns that the S&P 500 generated overall. And these seven stocks are now so big that they are well over a quarter of the S&P 500 index. They're more than 4 times the size of the small cap index, and they're way bigger than the UK market. Although it's just the numbers are just kind of silly now. The effect of all of that is it skews the style indices. So obviously, generally, large cap beats small cap, but that wasn't true in value. Here, the small cap outperformed. I think that's interesting. And generally, growth beat value. But again, this is really all down to what's going on with these big seven stocks. They really skewed everything. But because of those things, I mean, we had North American income results up this morning, and relative to this, they just don't look anywhere near as good, and that's because they're concentrating this large cap value bit, which is the worst performing in this kind of segment. There is a small cap portfolio too, so it's not it has got some exposure to that area. It's only 5% of the portfolio is in sub 10 billion market cap stocks. Remember, US division small caps are a lot bigger than us. But that's very, very broadly spread. So about 40 odd holdings in large cap and about 240 in small cap. And in terms of where the returns came from, that small cap was a detractor. So it took 1% off the returns in dollar terms. But they did outperform the large cap portfolio, and that made all the difference. Gearing helped a bit, which is obviously good. And they do sort of run some gearing, and that's obviously a tick in the box, and that helps offset the effect of fees and gearing costs and all that sort of stuff quite materially. So yeah, basically what I'm saying is this is a really quite impressive turnout. This is the top 5 contributors and top 5 detractors, and you can see. This is the power of NVIDIA there. Just having a very small overweight to NVIDIA added 1.4% to returns relative to the S&P 500. Or good, but obviously the AI story runs beyond those big 7 rather, into things like advanced micro devices and stuff as well. But it's also good, and this comes back to this balance of value and growth thing, that you've got a building materials company there amongst the top contributors. So yeah, tick, tick, tick. Basically, what I'm thinking more and more is that JAM is proving itself to be a core holding in the American sector. So there we go. That's JAM. And now Downing Strategic. We've talked about this before. It's not very big anyway, so we won't dwell on it too long. But they decided to give up last November. They published a circular in February, and shareholders, so 28th of February, shareholders voted and approved the plan to wind down the fund. They've obviously been freeing up cash, so they announced they were going to hand some of that back on the 8th of March, and they were going to use what they call a B share scheme. So basically, they issue B shares to holders of ordinary shares and then redeem those, and that creates a capital gain or loss depending on your circumstances. And that's a much more tax efficient way of treating things normally. However, this group called Milkwood Capital came along they started buying stock on the 15th of February, so between the second being published and the EGM actually happening. Not clear why the fact that they bought a stake wasn't announced to the market until the 18th of March, because they say they notified it on the 22nd of February. The couple of big investors have sold out. So Eco Investors sold out early on, and then later on, Thames Ventures 2 VCTs sold out. And that's allowed Milkwood to build a 28% stake in Downing Strategic. That's important because it's sort of blocking the ability to block all sorts of things. So to get the B share scheme approved, they needed 75% of shareholders to approve it, shareholders voting. Obviously, we've got this perennial problem that not everybody votes, and that always creates a problem anyway. They weren't even able to vote all the shares they owned, because I guess didn't get it organised in time. But nevertheless, that was enough, just them voting against, to block the approval of that B share scheme. And the board said they're doing it because they want to run the fund, which we'll come back to in a minute. So that meant obviously the B share scheme thing failed. And the board said, well, looking at this, we still think people want their money back, so we're going to pay the cash out as a special dividend. But obviously that now comes through as income rather than a capital gain or loss. And so therefore, from a tax point of view, if you don't hold it in a separate ISA, this might be really bad news, which is not great, to say the least. Going forward, because you need 75% to approve a liquidation of the fund. Milkwood can block that. They block most things they want to do, really, but they can't block them paying more dividends unless it tries to properly seize control of the company. And to do that, they're going to have to go over the head of the board and appeal to shareholders and say that we don't want to do this wind down anymore. Give control of the fund to us. So if I was them and I've got a decent case to make, I would now call an EGM and get shareholders to vote on that proposal. And if shareholders don't want to cancel the wind down, then by all means they can take the shell at the end. So we'll pay out all the assets that are in the company. And they can take the shell at the end and use that shell to do something if they want to try and raise more money for what they want to do. And what they want to do isn't clear, but the guy who runs Milkwood used to be head of emerging markets at Citi, and he's contrarian, he's activist, quite focused. So another kind of fund, maybe a bit like Aurora, maybe, or Castlemore. We'll just have to see what happens here, whether he just gives up and goes away. Watch this space. Finally, for me, a quick thing on Fidelity Emerging. We know that that's had a terrible period, largely related to it got handed over to Fidelity. They piled into Russia. They lost a fortune. It's starting to recover, but the discount's still quite wide. It's a decent size. This is ranking them by market cap. It's still the third biggest fund in the global emerging market sector. So it's a decent pool of assets that somebody would love to have their hands on, especially when you've got a new entrant like Ashoka who really wants to get a lot bigger. So it would be an obvious bid target for them, or just attempt to get the whole of the management contract for it. The returns were dreadful, and you can see this in the 3-year numbers here, and that's related a lot to what they did with Russia. But they have perked up a bit over the last year, which is helpful, and they are actually now beating the benchmark, which is also helpful. So I think they're starting to build a case again for hanging on to it, but there's a long way to go, I think, with that and shareholders. So they've just had a tender offer. There's 90 million shares in issue. Almost all of those were tendered. So basically, everybody just said, yours. We'd rather have cash, please. But the tender was limited to 13.5 million shares. Actually, the thing I picked up on is that 79.8 million shares is more shares want to get out now than couldn't get out last time. So they had a big tender before, if you remember, and everybody took that as a big vote against the Fidelity running the fund. And so the situation appears to have deteriorated. I don't think it's enough for the board to sit back now and go, well, we've done the tender, we tick that box. I do think that Fidelity have to really build a case and go to shareholders and say, do you want us to carry on running this? Your board needs to do that. Do you want Fidelity to go and carry on running this? Or shall we find a new fund manager, or shall we do something more radical with here and maybe just to liquidate it? I obviously don't want it to be liquidated. It's the biggest fund in the sector. I'd much rather the assets went to a manager that people actually want to be invested in. But I do think that there's a serious question being asked here that needs to be addressed. So that's enough from me. Let's now talk to Andrew.
Lovely. Thank you very much, James. Let me just share my screen and we'll talk about what has been happening in markets in March. Good. Well, actually, March was a very interesting month because we had an enormous amount of news flow in the sector that really caused some quite substantial price movements. Here's the list of risers. And actually, if we were to work down the list, we could probably explain nearly all of them in terms of news flow. So just a few: gold and prospect precious metals was benefiting there from a rising gold price. Digital 9 infrastructure, we know managed to push through the sale of Fern Global, Taylor Maritime Investment benefiting from disruption of global shipping, 3i Group benefiting from the strong trading news from Action, Custodian Property Income REITs actually bounced back because its bid failed for Aberdeen Property Income, etc. So effectively, I think it was a news-driven month rather than the market having a considerable strength of direction. And that was reflected really in the market index, which was up about 2% for investment trusts over the month. I think it lost about half of that this morning. But anyway, so there wasn't an overall strong directional trend, but nevertheless plenty to keep us interested. The thematic that I picked out from this was actually natural resources. You can see 4 commodity trusts on the list there going up, so I'll talk about that in a moment. On the way down, there's an outstanding figure at the top, of course, which is Asian Energy Impact Trust down 77%. That's because it came back to the market after its long suspension. So no surprise there, it came back at a much lower price. And I think here the outstanding feature, without any doubt, is the renewable energy space, which really suffered again in March, which is perhaps somewhat contrary to expectation because we felt it was quite sensitive to interest rates. And generally speaking, the news on the macro has been looking a bit better. I think there's quite a lot of consensus now centering around a rate cut, perhaps in June in the UK. But anyway, I'll talk about that as well. So let's have a look at natural resources, which really have had quite a good, strong start to 2024. The chart here is for the S&P Goldman Sachs Commodity Index, which is up 12% in the year to date. That's a broad index that covers all sorts of commodities. And actually, it doesn't take very much research to have a look at the news flow here and see just how positive it is across a broad range. So we know the gold price is at an all-time high. That's, I think, for a range of factors. Partly it's a reduction in interest rates because, of course, gold doesn't pay any dividends. So actually, the opportunity cost of holding it goes down when interest rates fall. There's also, I think, quite a lot of geopolitical hedging going on there where people are buying gold because they're worried about developments in the Middle East and still in the Ukraine and Russia. And of course, as well, you've got the influence of Bitcoin, which has been rising strongly. And I think that does also encourage people into gold as well, rather curiously. But it's not alone. So copper is also at a 14-month high. There's been quite a lot of supply disruptions here in places as diverse as Panama and Congo and Zambia. It does mean actually that if we do see a pickup in demand, I think the copper market may find it quite difficult to respond to that, which is why there's a bit of a squeeze on prices now. And actually quite a few banks are indicating in their forecasts that they're expecting that rally to continue. And oil is at a 5-month high as well, again, partly due to tensions in the Middle East. So there's quite a lot of impetus here, I think, and a double whammy, I think, from potentially falling interest rates. Because on the one hand, as I've explained, that's good for precious metals that are not yielding anything. And of course, it should also boost global economies and global trade, which is helping the more cyclical metals like copper improve. So I think both from the supply side and the demand side, you've got factors here pushing up prices. And I think actually there's quite a decent range of trusts in the sector. Many of them are quite small, but I've ranked them here by 1-month NAV return. And you can see there's a number that don't appear to have moved, but that's because they're largely in unquoted assets. The ones that are in listed equities have actually all done very well over the month, topped by Golden Prospect Precious Metals, which is about 80% gold. So that's really why that's at the top. Next on the list is BlackRock World Mining, which is really, I would say, the only large liquid trust in this sector. It's got 1.1 billion pounds of assets and it really dwarfs the others. So if you're needing some liquidity, that's really the one you're going to look at. The other reason to look at that trust now is that it does have the most negative Z score, meaning that its discount has varied the most at the moment. It's on a discount of 9.3% compared to its 1-year average of 3%. So in spite of the improved performance, the discount has widened. And this is a curiosity, actually, that I saw some interesting data from Panmure Gordon, and they were pointing out, actually, that this has been happening across the sector, that where NAVs have been rising, share prices have generally been lagging, and vice versa, which explains partly why discounts have widened in the Indian sector and have narrowed in the Chinese sector, just because share prices have not been reflecting the full movement. Anyway, to come back here, you can see from this chart at the bottom how the discount has just broadened over time here and is now approaching 10%. And this is quite a well-diversified trust. If you have good eyesight, you can see on the left here that it has 36% in diversified miners. So that's companies like Rio Tinto. And this is looking through. So it's not holding these commodities directly. It's doing it through equities. But 23% in copper, 13% in gold. So quite broad exposure. What you're not getting with this trust is any energy exposure. So it's not investing in oil and gas here. If you want that, you'll need the sister trust, the BlackRock energy one. But I do think it's quite interesting at this point because you're getting a bit more value here, and there does seem to be quite a lot of momentum in this sector. There's just one curiosity I'll just talk about very briefly. In the same sector, Geiger Counter, the uranium mining equities investment trust. This is, I think, probably the only trust now to be using subscription shares. Very close to my heart, these things. But it's a good way of expanding, actually, when, of course, trusts are finding it tremendously difficult to raise any new capital at all. Geiger Counter has an annual mechanism for this where effectively shareholders are given the right to buy new shares on a 1-for-5 basis at last year's NAV. And this time around, this opportunity is coming up at the end of this month. And the subscription price at last year's NAV is way below the current share price. So the subscription price is 37.74. Current share price is about 56. I just wanted to mention this because I want to urge anyone who is a holder to take up those rights because they're actually quite valuable. And if you don't take them up, you're missing out and getting diluted. So I think it's good news. I think it's an interesting mechanism and it does enable the trust to expand a little bit at a time when it's quite difficult for most to do so. So on the way down, renewable energy has had such a tough time, actually. And it's not because NAVs have been disastrous. Over the last year, I put the figure on here, NAV total return from the sector is plus 2%, and the average share price is down 17.4. So there's been this very big derating that's continued over the last month. Again, NAVs were up slightly over the month, share prices down nearly 5%. There are some reasons for this. I mean, it's not happening in a vacuum here. And I think investors are concerned about revenue weakness in the sector. And of course, it really hasn't helped that that was very marked in the battery storage sector, which I think has cast a little bit of a cloud over sentiment here. And more broadly, there are concerns over power prices falling. I think that's a really interesting topic because if you do speak to managers in the sector about that, they tend to dismiss these forecasts as being a necessary evil, but not necessarily very accurate, because it's difficult to look out several years. So that debate will continue. But in the meantime, we've seen this very sharp derating. And I've just pinched this chart here from Stifel Stockbrokers, who have looked at all of the sectors across the investment trust market over the first quarter of the year. And you can see, actually, they've nearly all derated. So this has been a broad derating of the market. But renewable energy infrastructure on the left here clearly stands out as being by far the biggest derating. After that, it's hedge funds, infrastructure, and quite a lot of property sectors. But I do think this big D-rating could potentially give you an opportunity to jump in. Many of the yields in the sector do look quite compelling now, between 7-8% on at the low side, up to maybe 11%. And clearly, you have to do your homework and make sure those are sustainable dividends. But I think now most of them are. And there seems very little doubt, actually, that in the majority of cases in the sector, the NAVs are quite firm now. They're quite realistically based. So I think there's some value there, and it could be that there's been some overshooting going on here. I think if you're an income investor, it's especially interesting. You can lock in these quite high yields now. Just one more slide. This is something, again, that I think was brought to mind very much by the news flow this month, and the news that Elliott had taken the 5% stake in Scottish Mortgage. I was just thinking about it, and the fact that Elliott's actually done very well out of this already and had quite a significant uplift in their stake. And also that Saba Capital, who was the earlier arbitrageur to come in, has actually done very well from its holdings, I think. So I wonder whether this might tempt some more ARBs into the sector, or potentially Elliott might take some more stakes elsewhere, which it has done in the past too. Elliott's not new to the sector. It was around at the last time that arbitrageurs came in the cycle. And there's actually quite a lot of double-digit discounts. I mean, as that chart from Stifel showed, the discounts have broadened right across the range here. And there are some quite large liquid equity trusts here that I think are trading on wider than normal discounts that could tempt ARBs. I did a bit of a sweep of this and wrote about it in this month's newsletter. I picked out 5 actually, but I've just got room for a couple here. So I'll give you 2 of the names we picked out. Temple Bar, which is on a 10% discount. I know you've just put out a research note about that, James, so you can go and have a read of that. I think it's quite attractive now on a 10 discount compared to its 1-year average of 6.2. Again, liquid trust actually doing okay at the moment. A trust that is really struggling, though, is Baillie Gifford Shin Nippon, which has had an awful time of it, actually. But again, I think it's interesting to put this into context and to remember that this was actually a really good trust for a very long time when growth was actually in favor. And so the 18% discount on this now is not only wide in relation to its 1-year average of 12.6, but massively wider than it had been previously. And I do think actually there's quite good scope for recovery here or some action. And you can see, from the chart in the bottom right here, that discount's just got wider and wider. And again, I just wonder whether that could be tempting for someone. That's just me speculating, so we'll see. That's it from me now. I don't think I have any questions, so I'll hand you over
Cool.
to Richard.
Thank you, Andrew. I mean, just an observation on Temple Bar while we're here, because we noted this week, it massively outperformed Merchants Trust last year. But Merchants Trust issued 40 million quid's worth of stock, and Temple Bar shrank. There's no logic going on here. I need people to look at things more carefully before they pile in. There we go.
I think that's right. There's quite a lot of anomalies in the sector, and that's your job to help point them out, James.
Exactly. Cool. Right then, let's hand over to Richard, and I'll go quiet. Thank you.
Thank you, James. Excuse me, I'll just get to the right bit. Oh, sorry. Let's get your slides on. Apologies for this. Sorry, I'm in the kitchen today.
Okay, don't worry.
Got issues with my Wi-Fi in my office, so
There we go.
like this, I'm afraid. So, Simon, are you there?
I am indeed, Richard. Yes. Good morning.
Hi, Simon. How are you?
Good, thank you. Good.
Good. Yeah. So I think we'll do what we normally do with our special guests, and have you just sort of run through what the company's about, what you're trying to achieve, and then we'll get some questions in.
Great. Well, thanks very much. I've got a few slides just to sort of refresh people's knowledge of the business, the sort of thesis behind it, and what we've been doing since we IPO'd So good morning. My name is Simon Farnsworth. I'm the MD of Ironstone, the REIT's external investment advisor. Life Science REIT is the UK's only REIT focused on the life science sector. As I say, externally managed, and really having IPO'd in November 2021, we were oversubscribed at the time, raised 350 million, and successfully deployed all of those proceeds within our first 6 months of our operations. And absolutely key to us was having a portfolio of assets under exclusivity that we could acquire and deploy that capital quickly, which we did. And the portfolio today now comprises of 5 assets across Oxford, Cambridge, and London, and just over 500,000 square feet of life science space. And I'll come on to exactly what that means for investors shortly. So just flipping forward to the next slide, why the UK? Why the UK particularly for life sciences? Well, we now have 5 of the world's top 10 universities for medicine in the UK. And in addition to that, it's well publicised what we've been seeing across the UK market over the last few years. Top level clinical research has to be near, in our view, academia and key teaching and research hospitals. And what is really clear through that is you get this collaboration. You create an ecosystem, you get a transfer of knowledge, ideas, and an evolution of science and creativity. And this is a well-established formula that came out of the clustering theory, and particularly out of Harvard and Boston, which is probably the global head of HQ, if you like, of life science in the world. But this is a really well-established formula now, and it's playing out really strongly in what people will know in the UK as the Golden Triangle between Oxford, Cambridge, and London. And specifically within London, we have an area called the Knowledge Quarter around St Pancras, King's Cross, and Bloomsbury. And this Golden Triangle across these 3 points, if you like, is globally recognised as an advanced top-tier life science cluster. It's the only one in Europe that's recognised as that. And it has large, world-class hospitals and universities. You've got Oxford, Cambridge, UCL, Imperial, and now King's has entered the top 10 in the world for medicine. You've got world-class teaching hospitals, UCH, the John Ratcliffe, Adam Brooks, strong corporate links, mature funding markets, and deep, affordable talent pools, which is absolutely key to occupiers and research facilities. And at the southern tip of the Golden Triangle, if you like, London's Knowledge Quarter, in my view, this is Europe's premier cluster. And this is, in a nutshell, what we call genius loci, if you like. Here you've got the Francis Crick Institute, you've got DeepMind, Google's AI business, you've got UCH and UCL, Great Ormond Street Hospital, the Alan Turing Institute. And it's no coincidence that MSD, formerly known as Merck, the global pharmaceutical company, looked all over Europe where we're going to put our new £1 billion R&D headquarters. And they've broken ground recently right opposite King's Cross Station. And in my view, this really encompasses what it's all about. Next slide, please. So life sciences, it's not all test tubes and Bunsen burners. It not only includes sort of pharma and healthcare now, but really involves a huge amount of data, technology, robotics, and even agri-tech. I mean, technology in particular is becoming key within life sciences, and it's every day you read in the papers. Even yesterday on the front page of the Times, there's a new dementia blood test that's been developed by Oxford University and University College Hospital and University College London. A great example of the sort of collaboration between businesses, academia, and research institutions within the Golden Triangle. Technology, as I say, is driving this. It's sort of almost turbocharging the pace of discovery and broadening the field of life sciences. There's a new industry term, deep biotech, which really is designed to cover areas like quantum computing and AI, and modern biotech, such as gene editing, gene therapy, which again, you'll read about nearly every day in the papers these days. And as you can see on this particular slide, this is really resulting in an influx of new investment into the sector by some of the world's largest tech companies. Traditionally, it's been quite a sector quite pump-primed by VC and private equity. Interestingly, in 2023, UK venture capital investment was down 43% across the whole of the UK economy. Life sciences was pretty flat, down only 6%, which gives a really good indication of the sort of strong levels of investor interest in the underlying businesses. But here you can see, some seriously big tech players now branching into the sector, whether they're using their own AI or they're setting up their own drug discovery businesses. So very exciting for the sector and really broadening the investor base for companies operating in life sciences. But ultimately, what does this mean for real estate? Well, the clustering of all these innovations is already happening across campuses. The major impact of this rapid change now is the need for flexible space that occupiers can take, and it's got to cater for so many different types of uses. And we'll come on to that in a minute, but a lot of these uses might not even exist today. And this is what we're responding to as a business through our, particularly through our asset management activities. So next slide, please, Richard. Thanks very much. So when it comes to the real estate supporting life sciences, it can take many different forms, and this really depends on each occupier's business model. We still have traditional offices in the sector. I mean, scientists call it write-up space. It's still a big requirement. We have wet labs, which is where scientists can manipulate liquids, biological matter, chemicals. We have dry labs, which is space really focused on computers, physics, and engineering. And then other forms of real estate now relevant to the sector include data centers and production. I think production is really interesting. It's become, again, on the rise over the last few years, particularly post the pandemic and post Brexit, as more and more organizations now are seeking supply chain security for important drugs, for R&D, and that all became very apparent, both, as I say, post Brexit and during the pandemic. So a lot of businesses are now looking to relocate production back into the UK, which is really interesting opportunity for us. All these types of uses fall under the real estate umbrella of life sciences. And you can have companies that have all of these uses under one roof. And in our portfolio, we're trying to create the right sort of flexible space in the right locations to cater for these modern occupiers. Next slide. Thank you, Richard. On this slide, I'm trying to set out exactly how we're investing our capital to create value for our shareholders. And we've deliberately assembled a portfolio with opportunities to deliver space for science and technology, either through ground up development, such as what we're doing at Oxford Technology Park, and I'll come on to that in a minute. We're repurposing space for laboratories and other science and tech uses in Cambridge and in London. And the cost of this obviously varies depending on the type of building and the scale of the scheme and the level of repurposing that's required. But generally, in terms of the upside, fully fitted laboratory space can achieve rental premiums of between 70 and up to 100% over traditional offices in these locations. And laboratory space is also being valued on a tighter capitalization yield, and that premium is around 75 basis points. So thus we're seeing enhanced rental levels and enhanced multipliers on our values, and all of that will be driving long-term capital growth and earnings growth. The next slide gives you a brief snapshot of the portfolio. I'm not going to wade through all the detail here, but we have 5 assets now, spread across Oxford, Cambridge, and London. Our biggest asset is a ground-up development opportunity at Oxford Technology Park, where we're developing nearly 500,000 square feet of laboratory and production space. And you can see here some of the key portfolio stats. Our contracted rent is £15 million. But the ERV of the existing portfolio is nearly £20 million. So real headroom for rental growth there. And there's plenty of upside to come through further development and further repurposing of space. Interestingly, our occupier base on the next slide is dramatically changing as well. We do have sort of legacy occupiers, non-life science businesses. But what we're doing as we repurpose and redevelop is driving up the percentage of life science businesses within the portfolio. So that's now increased to over 50% with new lettings to companies like Beacon Therapeutics and by Syncona, Oxford Gene Technologies, and Fortescue WAE as well. Interestingly, we had 100% rent collection last year. We had not a pound of irrecoverable rent, and I think that really demonstrates the strength of the sector, but also demonstrates the strength of our underwriting. When we're leasing to businesses, we spend an awful lot of time. We have 2 in-house scientists in our small team who spend all their time researching prospective occupiers, underwriting their business plans, looking at their cash flow models, looking at the science, looking at their funding, to really make sure that we're backing the next winners here and providing space for companies that are in a real growth trajectory. So very briefly, just want to get our hands dirty, if you like, on the real estate, because this is the nub of the business, obviously. Oxford Technology Park is a 20-acre campus with about 500,000 square feet of life science space planned, just north of Oxford, 7 miles north of the city centre, and very importantly, adjacent to Begbroke Science Park, which is one of the university's main incubators. Begbroke is actually full, it's expanding rapidly, and many of the smaller startups and growing businesses move on from Begbroke, and we're a natural home for them as they mature and look to establish their own independence. And what we provide on Oxford Tech Park is a range of buildings from 6,000 square feet all the way up to 50,000 square feet, where businesses can move in, they can grow, and they can hopefully have sort of cradle to grave facilities on the park. We're now 66% occupied. We've got more space to build out. You can see here a number of buildings are still under construction. But this leasing activity, where we've added over £3 million of rent just in the last 12 months, we've seen rents grow by over 30% here since we acquired the park back in May 2022. So in less than 2 years, we've seen that sort of level of rental growth. And this space is still very affordable. It's relatively cheap to build. We build these large tech boxes, which are large 2-storey flexible buildings that can house labs, offices, R&D space. They have plenty of power. They have enhanced power supplies. They have PV panels. It's a very green scheme, and it's proving very popular with the occupier market. And we are seeing, interestingly, a lot of AI, quantum, and robotics businesses starting to cluster at the park, all of which have sort of life science related uses. Very briefly, moving on to our flagship London asset at Rolling Stock Yard, just on the edge of the Knowledge Quarter. Most recent deal here was to a Syncona-owned startup called Beacon Therapeutics. And what we've done here is repurpose traditional office space, which could be let at £60–65 a square foot, into fully fitted laboratory space. And we set a record rent for London lab space in this building at £110 a square foot. Obviously, a significant premium over traditional office space. Not every building converts to labs. I think there's a lot of publicity around, you know, every vacant Debenhams department store in the UK being repurposed. Not every building works. In fact, many don't. You've got to have power. You've got to have the right configuration of the building. There's a lot of factors that go into underwriting these buildings prior to acquisition and prior to conversion. And we've got a very small team, but some really good consultants we work with to help us underwrite these assets. And then finally, Cambourne Park, which is on the outskirts, 7 miles west of Cambridge. It's perhaps the asset with the biggest long-term value add in the portfolio, actually. It's about 250,000 square feet. We already have some great science and technology businesses like Carl Zeiss and MTK. We rebranded the park, and subsequently we've completed our first laboratory letting to an agri-tech company. But the wider opportunity here is to actually convert vacant office space, or soon to be vacant office space, to laboratories. And we have about 80,000 square feet of this coming available for conversion by the end of 2025. Now, the basic values here, to keep it simple, are the assets as offices are valued at about £350 per square foot capital value. We will spend on an average £250 a square foot of capital expenditure to fully fit that space with laboratories, upgrade the power, upgrade the amenities. So an all-in cost of £600. But the end-out value of these, when they're leased as labs and capitalised by the valuers, is closer to £900 a square foot. That's a significant margin on the additional capital expenditure. And we'll be rolling this fit out across Cambourne Park over the next few years. Cambridge has a chronic undersupply of space. There's over 1 million square feet of demand for labs at the moment. Currently available about 100,000 square feet. There is some supply in the pipeline, but given what's been happening in the financial markets over the last sort of 18 months, particularly, a number of those schemes have been mothballed. Developers are struggling to get development financing, and are struggling to commit to speculative ground-up development. We've got buildings here that we can bring to the market very quickly. They're up and built. The fit-out's commencing, and we will be looking to drive rental levels on this to over £50 a square foot, stood a significant discount to the prime Cambridge laboratory rents, which are now in the mid-70s. So we're well positioned for future growth, and despite the wider macro uncertainty over the last couple of years, we've continued to focus on our asset management initiatives, which will drive rental growth and earnings. Over the longer term, we expect more and more of our portfolio to benefit from the rent and yield premium that I've demonstrated earlier, that life science space is achieving in the short term, and we'd expect interest rates and valuation yields to further stabilise now. I think we've got real visibility now on where rates are peaking out. And that will in turn provide visibility on where valuation yields are peaking out in the UK real estate market. We're beginning to see some liquidity return to the real estate capital markets. Overseas investors getting on planes, coming to London, coming to the major cities, looking at opportunities to invest in the UK. I think all of that will be beneficial to underpinning values and seeing further earnings and capital value growth. But it's really important as a business that we maintain our discipline around capital allocation, shore up our balance sheet, make sure we've got the capital to deliver on these projects, and provide a best-in-class portfolio here both for our investors and really importantly for these sort of growth businesses within what is a really exciting growth sector in the UK real estate world. So that really concludes my sort of summary of the business, and hopefully it's given you a flavour of the sort of projects that we've got underway in the portfolio.
Yeah, great, Simon. That was really good. Questions have begun coming in thick and fast, so we'll crack straight into them because I'm conscious of the time. I'll try and group some of them up. So obviously there's a lot of office space that you're converting into lab space. What is the valuation differential between the two?
Yeah, it's a good question. I mean, just to take, obviously sub-market's slightly different, but broadly, the valuation is about 100. It's between 75 and 150 basis points on the valuation yield, on the multiplier, if you like. So a really prime laboratory building in Cambridge will be valued in about 5.5% cap rate, maybe even closer to 5%. Whereas offices at the moment, our offices are valued in between sort of 7 and 7.5%. So there is a fairly significant yield compression there, and that's driven by prospects for growth. I mean, we're seeing rents move, but in our view and in the market's view, there's still a really good headroom for further rental growth.
Yeah, and a couple of questions on fitting out or refurbing the office space into lab space. What I think you ran through an example in your presentation, but what is the sort of the average cost of refurbing that space, and what is the sort of premium or return on that you get at the end?
Sure. I mean, it varies. I mean, the two examples I can give is at Oxford Technology Park, where we're fitting out the sort of shell units with they already have new air conditioning in there. They already have all the M&E, as we call it. That's costing between £100 and £120 a square foot to put fitted labs in there, capital expenditure. But in return for that, we're taking rents from £22 a square foot to the most recent letting we've done at 45. So we're more than doubling rents for about £100 of capex. At Cambourne, slightly different. They're older buildings. They require a lot more of the sort of air conditioning, the M&E to be upgraded. We're probably going to spend on average about £250 a foot there. But again, we're doubling the rents from low 20s to 50 plus. So the payback is reasonably swift, but also we're seeing significant, as I say earlier, yield compression, which gives us that sort of double whammy, if you like. We get the rental uplift and the capital value uplift.
No, that's interesting. So what's the occupancy of the portfolio at the moment, and what is the yearly churn on the space?
Yeah, the occupancy at the moment is about 79%. It was slightly down on last year because we actually delivered more space at Oxford Tech Park. So on a like-for-like basis over the 12 months, we actually went from about 80% to 85%. But because we built more space, the actual overall occupancy was down slightly to just about 79%. That's fine. I mean, we are creating space for science, and to have occupancy is an opportunity for us. We need new lettings, obviously, to drive the rental growth. What we don't want are a lot of long leases with sort of RPI indexed income, because that, in our view, and what's proven in the market, is that rents are growing faster than inflation. So we want a reasonable level of structural vacancy within the portfolio.
Yeah.
I mean, on a stabilised portfolio, that would probably be a vacancy rate of between 5 and 10%. So we've got a bit more to go there.
Yeah. So a couple of questions have come in about how you're going to sort of grow the business. And I know you mentioned in your annual results that you were looking at sort of JVs or co-investments as a way forward. Can you talk a bit more about that?
Yeah, absolutely. I mean, obviously, we're not going to dilute our shareholders raising money at discounts to NAV. I mean, there have been a few, obviously, in the real estate sector recently where people have been trading at relatively small discounts. And if you do that and you've got a plan for the capital, then I think that does make sense if it's accretive. But what we would look at, I mean, to be clear, at the moment, we're rolling our sleeves up and really focusing on delivering on the assets that we acquired at post IPO. I mean, that's absolute focus. But if to grow the business further, would we look at strategic joint ventures? Absolutely. And we've got some really interesting assets in our portfolio. These are assets that took a lot of time to piece together off market. And they're assets that are sought after by investors. But there's a lot of capital looking at the sector. You probably saw recently that British Land announced the joint venture in London with Royal London. Now that's exactly the sort of thing, yes, the sector should be doing. If we can't raise money through the public markets, then there is a significant amount of private capital, whether it's people like Royal London or the big Australian superannuation funds or Canadian funds, who are looking to access the sector. But we would only do it if it was an accretive opportunity for our existing shareholders. So whether that's selling a stake in an asset and redeploying our share of that capital with a partner into a new, more accretive asset that we can find in the market or off market, that's something we would obviously look at, but only if it worked for our shareholders.
Yeah. A question here on the occupiers, and the life science startups, and so what is the sort of normal failure success rate of a life science startup? And additional question on how strong the sort of venture capital market is for this sector.
Yeah, good. Two good questions. It's I don't have any stats on the failure rate for sort of startups. Most of the businesses we've got coming into our portfolio are sort of second phase funded businesses. So if you look at our most recent deal at Oxford Tech Park, big deal was with a company called Oxford Ionics, backed by Oxford Science Enterprise, which is the university's investment fund, and we have a guarantee on that lease from the university's investment fund. So we're very, very careful looking at the covenant strength, the financial strength of occupiers. We've got Beacon Therapeutics come into our London property. They're owned by Syncona, who are obviously a well-established investment trust. So we don't have what I would call a lot of real startup risk, but we have two scientists in our team. As I say, we have a small team. We have two full-time well-qualified scientists who spend their time looking through to prospective occupiers, running through their business plans, their models, running through the science with them, looking at who's funding them, who's backing them, and working with us as a team to sort of help deploy effectively our capital into investing in the real estate for these companies. So we spend a lot of time looking at them. In terms of VC funding, it stabilised last year into life sciences at around £2 billion. That was down from the peak during the COVID years of about 2.5.
Right.
UK VC investment, I'm told, last year was down about 43% across the whole of the UK market. Life sciences was broadly flat. Life sciences was only down 6%. So I think that gives you an indication of the sort of attractiveness of this particular sector to VC and that sort of investment community.
Yeah, that's interesting. We've got a question here which is specific to Oxford Technology Park, but I think could roll out across the whole portfolio. So obviously you spend money fitting out the lab spaces, and with the leases that you then bring in maybe they have a break option after 5 years. What do you do to sort of protect yourself if that break option is exercised in your costs and things like that?
Yeah,
So,
it varies. Some of them do have breaks at year 5. It varies enormously. I mean, we're not adverse to that. I mean, it gives us an opportunity. If we view rents are going to continue growing, it gives us an opportunity then at that time to capture a new higher rent. I think there are a number of factors peculiar to this sector. First off, they're quite sticky occupiers. What we find with life science businesses and high tech businesses is they don't like moving. It's really disruptive. We're talking to one occupier at the moment. He says it's going to take them 12 months to wind down their scientific processes to the point where they can safely move the business into our building, and that's fine. We can work with them on that. So once they're in, they tend to stay, and often they will take more space than they need day one because they're happy to pay a little bit more for space that they can then grow into. With a view that they don't want to have to move in 3 or 5 years' time. And we've got the sort of space and the sort of structures that we can provide that sort of flexibility for them, which is absolutely key. We build in sometimes penalties, so they pay a rent penalty if they exercise the break, but also on the fully fitted spaces, that's our equipment. So if they do move, we keep it. They have to pay to sort of bring it back up to an occupational standard, and then we can relet that space with all the equipment as is. So actually, it's not a big hit. We look at least a 10-year life cycle now for these units.
Yeah, no, that's good. A lot of questions here on the debt. I don't know, just want to run through sort of the debt profile.
Sure.
When that matures, what the costs on that and things like that.
Yeah. Oh, absolutely. Our current loan to value at year end is just under 25%. Our target range has always been 30 to 40%. And we refinanced the business back in May with HSBC and Bank of Ireland. That facility runs through to the middle of 2026. And then we have 2 one-year extensions on the back of that. We're fully hedged now until the middle of 2025. And we're actually forward hedging. So as we draw debt down for whether it's for capital expenditure, we have bought forward caps, if you like, to make sure that we're locked in. So we're slightly over hedged at the moment. I think we're about 106% hedged on our debt, which is fine. We've actually got some really good swaps in place on the bulk of the term loan as well. So we've got 2 very supportive lending banks. They totally get the business. They understand what we're doing. As I say, with 100% rent collection, we've obviously got great cover. So we're in a good place there.
Yeah, good. Question here, and I think we've talked about this recently. That what's behind the share price weakness in recent months? It seems that we've been making good progress on lettings, but the share price seems to just keep going down. What's your view on that?
Yeah, frustrating. Obviously, as a team, we've been buyers. Post results. I think there are a number of factors. I think obviously the REIT sector as a whole has suffered. I think people have been waiting for visibility on where valuations have fallen. Our fall in NAV at year end actually was one of the. If you look at the actual underlying fall in the value of the portfolio, that was really the only assets that fell in value were ones that are still valued as offices where we haven't got stuck in and converted to laboratories yet. And actually, when you benchmark the fall in value against the indices and our contemporaries, we were actually one of the best performers. So it's frustrating. I think we're a small stock, and the shareholder base is quite tight at the top end. We've had 1 or 2 multi-managers who have been selling out of REITs generally, which has had an impact. But we don't see any correlation between the share price and what's happening operationally and within the portfolio. We just got to be patient.
Yeah, good. We've had a couple of questions on how do the directors and does the management team own shares in the company? I think you just mentioned it there. That brought some.
Correct. Yeah, the management team, Ironstone. I mean, we bought 3 million shares, over 3 million shares at IPO, which we still hold. we've all been buying through the last 2 years. The Einstein Asset Management itself as an entity now has over, I think, over 1 million shares, which we buy on a sort of quarterly basis. So we're well vested in the company, and post results, the team have been buyers. So we strongly believe in the thesis, and as I say, we don't see any correlation at the moment between the share price and the underlying portfolio.
Question on dividend. You obviously cut that recently. Is that now at a more sustainable level going forward, and do you hope to grow that in years to come?
Absolutely, yeah. I mean, it was a decision that the board didn't take lightly, and you know, this was something that when you looked at the share price, you looked at what we want to do with the capital that the business generates. You know, hopefully I've demonstrated by talking you through some of the projects how accretive this process is by converting and leasing to as a laboratory space, both from an earnings perspective and a value perspective. So what we're saying is at the moment, you know, that 2p is rebased now. It's covered. Future dividends will, you know, going to be at that sustainable level, and they will reflect the progression in underlying earnings, and the underlying earnings will be driven by our leasing up of the space that we're building and developing. So we see this very much as a one-off rebase, and from here, hopefully, we're looking forward.
Yeah. Well, 12 o'clock now. But I think I'll leave it on. It's a bit of a statement rather than a question, but I'll get your thoughts on it. The worry is that the business will be taken out at a big discount, a bit like some of the other REITs. Is that a worry for you?
I say a worry. We can't do anything about that, Jen. I mean, we're focused, 100% focused on what we do around the portfolio, and you know, I think every REIT or every business trading at a discount is possibly vulnerable. But as I say, that's not our decision. That's something for our shareholders to and our board to decide. So you know, as things stand, we just carry on doing the best we can on the portfolio.
Yeah. Great. Okay. Well, yeah. Thanks a lot for coming on and discussing all of that. And it was really interesting. And we'll see how it goes going forward.
Good to speak to you again. Thanks, Richard.
Thanks.
Thanks, Richard. I'll just do the sort of end bit, if I may. So thank you very much again, Simon. That was great. We'll be back next week talking to JP Morgan Global Core Real Assets, JARA. And as usual, we've got a full lineup of things. We are sorting out what's going on the 3rd of May. We did have UK commercial property, which may not exist by then. So I think we're looking for somebody else, but we'll let you know what happens. But thanks again for tuning in this week, and have a good weekend, and we'll see you next Friday. Thanks. Bye-bye.